Hey Bowtie Nation, Joseph Hogue here, and if you think inflation has been bad lately, you ain't seen nothing yet. I started warning about inflation back in May of last year when the Consumer Price Index was up only 4% for the year and everyone was saying higher prices were only temporary. A year later, and consumer inflation has jumped to 8% a year. But nation, higher prices are about to get shockingly worse, and every investor needs to be ready for this. In this video, I'll show you why inflation is about to jump higher, why that could be a bad thing for stocks, and what you can do to protect your money. We'll look at the types of stocks that do best during higher inflation, and then I'll reveal the 5 stocks to watch on double-digit inflation. In fact, 3 of these stocks I'm adding to our 2022 Bowtie Nation portfolio. I'll leave a link to Stock Card in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtie Nation portfolio in the Stock Picks section. It's free to follow, and you'll get email notifications whenever I buy or sell from the list. Don't forget to use the promo code Bowtie Nation, that's all one word and lowercase, for an exclusive discount beyond the free trial. We're getting started, but before we do, you know I've got to send that special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I want to get started on our list of inflation stocks, so I'm going to wait to show you why inflation is about to explode higher and the danger of it for investors. Our first stock is in one of the clear winners of inflation-fighting sectors, energy stock NOV Inc., ticker NOV. NOV is a leader in oil and gas drilling and production equipment, as well as oil field services in 61 countries. From 2014 to last year, a historic drop in the price of oil led to a plunge in demand for these equipment and services, forcing a massive restructuring at NOV that saw headcount shrink by 56% and a cut of $12.6 billion in costs. Now, since last year's surge in energy prices, explorers have been pretty disciplined in not increasing production as much as in past cycles, really to keep those prices high. But has the recent jump in oil to over $130 a barrel, it's seeing a lot of expanded plans for production, and that's going to be good news for equipment and services companies like NOV. For the future, the company is also transitioning into renewables in geothermal, solar, biogas, and wind. In fact, management is forecasting an annual run rate of over $400 million in its wind division by the end of the year, double the rate from last year. Now, shares are already fairly priced here after the run-up lately, and the average analyst target of $19.59 a share is only 3% higher, but I think this one can still provide some upside along with that safety in inflation. We've still got 4 more inflation stocks to highlight, including the ones I'm adding to our portfolio, but it is worth asking, do stocks even do that bad during inflation? And in reality, most of the time, you really don't have to worry about inflation affecting your stocks. Research here by Hartford Funds on stock returns and inflation since 1973 breaks the market into 4 periods. Here, when inflation is low, under 3% a year, but is rising, stock returns beat the inflation rate 90% of the time, so nothing to worry about there. Now, here where inflation was high, so above 3% on a year-over-year basis, but showing signs of coming down, that's the 3rd bar on the left here, stock returns still did pretty well, beating the inflation rate 76% of the time. This last bar on the right here, when inflation was low, so under that 3% level and falling, here again, stocks ended up doing really well, beating the inflation rate 4 out of 5 years, or 81% of the time. But look at that second bar. When inflation is above 3% a year and rising, that's when you have a problem, and that's when you need to worry about this. During those years, high inflation getting higher, which is exactly what we're seeing right now, stock returns were no better than a 50-50 roll of the dice. This graph shows an amazing relationship between those stocks and inflation. Here you see the price-to-earnings ratio of stocks on the left, how much investors are willing to pay for those earnings produced by the stocks in the market. Across the bottom, then, is that inflation rate. And again, what you see here is that low levels of inflation, under 3 or 4% a year, investors are still willing to pay those high PE ratios for stocks. They're still willing to pay a higher price for the earnings of a company that can produce it, and so stock prices generally stay high. But then look at what happens when inflation increases. The effect on stock prices is much more focused here, dragging down the price investors are willing to pay. While at that low inflation, investors just aren't concerned and are willing to pay that 20 and 30 times for a company's earnings. When inflation surges, though, beyond 7%, investors just are much less optimistic. Those same stocks may now only be valued at maybe 10 or 15 times earnings. And if earnings stay the same but that multiple decreases, that means the prices are coming down hard. Now, I want to get back to our list of stocks, but later I'm going to show you why inflation is about to rocket higher into that area where investors start to freak out. In fact, it's coming this month, and it could lead to another panic selling in the market. The Kellogg Company, ticker K, has seen its shares stagnate along with most of the other stocks in the processed foods category, but I think much of the worst is priced into these shares. Now, the problem has been that while stocks in that consumer staples sector generally do pretty well during inflation because they sell the kind of things that you have to buy, like, well, Pop-Tarts, the competition is so fierce that companies have trouble raising their prices to completely cover the inflation on their own costs. But Kellogg's holds a number 1 or a number 2 market share in most of its product categories and is booking 10% plus growth in emerging markets. Management guided to a stable 3% sales growth and up to 2% earnings growth this year, so already accounting for that hit in inflation. Shares here are trading for just 1.5 times on a price to sales basis, a 25% discount to the multiple of 2 times sales back in 2016 and 2017. So there is some real value in this stock. Analysts see the shares to $68 each over the next year, a potential return of 10% on top of that 3.8% dividend yield. Now, another stock I'm adding to our portfolio, Biogen Inc., ticker BIIB, for its valuation and healthcare's resistance to inflation. Biogen is a specialty drug maker focused mostly in neurology, which has helped it create that leadership position in research and development in that space. I also like its recent initiatives in digital health, though, probably the strongest growth sector for the market. Our revenue and earnings have been weaker for Biogen over the past 2 years, but it's been pretty much the same for most of its competitors as well. Management is now guiding for $10 billion in revenue and up to $16 per share earnings this year, both of which would be slightly lower than last year, but the company has a strong pipeline of drugs for that future growth. Of the 32 clinical programs, 10 are in phase 3 or approved, so that could start bringing in some real revenue growth very soon. Biogen has a strong balance sheet with just over $2.6 billion in net debt, which is still relatively low for a big pharmaceutical company like this, and it generates $3.4 billion in free cash flow a year. Instead of a dividend, the company is aggressive in its share repurchases, buying back $1.8 billion in shares last year, or about 6% of the stock outstanding. Now, besides just that stable cash flow, I also like this one on the valuation side. Shares trade for just 2.7 times on a price to sales basis, well under the 5-year average of 4.2 times, and well under competitors like Amgen with its 5 times price to sales multiple. Analysts have an average price target of almost $255 a share, which would be about 21% higher from here, plus that safety from what inflation is doing to other stocks. Nation, we've been watching inflation run higher for almost a year now, so why am I now saying things are about to get worse? Why is it now that I think higher prices could really accelerate and start hitting stocks? Now, one thing you need to understand here is how important expectations are on inflation. The idea that once we start down that path of higher prices, people are going to start expecting it, and that's actually pushing prices up even higher. If people think prices are going to keep rising, they're going to ask for those higher raises, and if they don't pull back on their spending when inflation hits, Nation, this can all become just a vicious cycle of higher expectations feeding into higher inflation until we're at double-digit price increases, and it's starting right now. This is a survey on price changes expected by consumers conducted by the New York Federal Reserve. It shows how much consumers expect prices to rise in 6 of the most important areas around inflation: gas prices, food, medical care, education, rent, and the price of gold. And you see here, before the pandemic, expectations for rising prices were pretty subdued. In November of 2019, consumers expected the price of gas to rise by just 3.7% over the next year, and rent prices to increase just 5%. Food, for its part, was expected just 4% higher, and even the highest inflation in the cost of medical care was expected to rise just under 6% over the next 12 months. Now look at what's happened since though, how runaway prices are feeding those expectations and could ignite that cycle of even higher prices. As of last month, consumers expected gas to rise another 8.8% over the next year, and food is expected to get 9% more expensive. Renters are expecting their costs to surge by 10% over the next year. And all this while those expectations for inflation have jumped higher, a turning point is about to happen that is going to take this into overdrive, and it is happening this month. When the Consumer Price Index, the CPI, which is the main measure of consumer prices in the United States, when that is released on April 12th, it is going to show the highest inflation since 1981, possibly as high as 10% on a year-over-year basis. You see how prices have already surged to 8% a year, but that jump to double digits, it's about to take this to a whole new level of panic. And if you've tried filling up your tank lately, you know what I'm talking about. Surging oil prices from the Ukraine invasion have caused gasoline prices to spike 31% in less than 3 months to an average of over $4.30 a gallon. Bigger still though, and something consumers haven't seen yet, is the surge in grain prices that are soon going to make your food even more expensive. Russia and Ukraine combined produce over 50 million tons of wheat a year. That's more than a quarter of the global exports. The two countries are also big exporters of corn, about 16% of global demand, and almost a third of the world's supply of barley. The conflict has caused a surge in the price of wheat, up 70% in just the last month, along with a 24% increase in the price of corn. So that rise in energy prices is going to start showing in the Consumer Price Index when it's reported this month. And the shock in grains, that's going to start showing over the next several months. That is all going to increase that year-over-year inflation to another 40-year record, and the shock is going to trigger those follow-on expectations for even higher prices. Now, real estate is one of the best sectors to be in during inflation, and I'm adding shares of CoreCivic, ticker CXW, to our portfolio for April. The company is the largest private owner of real estate leased to government agencies, more than 16.5 million square feet in prisons and detention facilities across the country. And while there's been a lot of fear in these shares over prison reform and lower demand over the last few years, there are still a few reasons I don't think it ultimately hurts the stock. First is that most recent attempt at prison reform has become a huge hot-button election issue, and it doesn't look like either party wants to take a chance on further changes. Second, these facilities have long-term leases with a tenant that you know is going to pay the bills. And finally here, most of these properties can be used for other purposes, so even on massive reform, there is still value in these assets. The company has a track record of 40 years with extremely stable earnings and a 95% retention rate on its contracts. Profitability hasn't dipped below 21% in more than a decade, and there could be a big catalyst coming up. CoreCivic discontinued its dividend in March of 2020 to protect cash flow and then lower its debt. Its total leverage ratio is now down to 2.9 times from a high of 4 times in 2018. And the company has a strong history of dividends when it was a REIT stock, and there's a good chance they announce that return to dividends this year, which would be an instant boost to the shares. Analysts here have an average target price of $12.35 a share, more than 26% higher from here, and I think you get there fast as soon as the company announces a return to that dividend. We've still got one more inflation-fighting stock to highlight. In fact, the third stock I'm adding to our 2022 Bowtie Nation portfolio in April, but I want to step back and show you the bigger picture here. Those of you in the nation know I love that top-down style of investing, starting from that big picture, the higher level trends and sectors to see which are going to benefit from a theme, and then using that to narrow down my list of stocks. You see, starting from a list of the 5,000 plus stocks in the market, it's an impossible task, but if you know that virtually all stocks in a sector of the economy are going to get a boost from a theme or a trend, then you're going to first narrow your list down to just a few hundred in that sector. That way, even if you don't pick the very best stock in that sector or the industry, you know you're still going to do well because all those stocks in the group are going to benefit from the trend. And if we look back at that Hartford research, we see not only how the stocks in each sector did during inflation, but also how often they beat inflation. I know it can be a little confusing here if you're not a numbers nerd like me, so I'm going to walk you through this and then what it means for your stocks. On the left side here, so how high up or down a sector is, that's the sector's return performance when inflation was higher than 3% and rising as well. So you see stocks in the precious metals and minings industry, and part of that materials sector, they did really well, on average a 7% return. Conversely though, stocks and mortgage REITs in that lower left did relatively poorly, typically falling 10% or more when inflation heats up. Across the bottom though, this shows the percentage of the time stocks in each sector had positive returns versus inflation. So the farther to the right a sector is, the more likely it is to beat inflation. Here we see that stocks in sectors like energy, Equity REITs and consumer staples are the most likely to beat inflation when prices shoot up. So let's take a look at a few of these because this is some really valuable information for how you invest over the next year. If we look at the lower left here, these are the sectors that get hit the hardest on those rising prices and are most likely to underperform. Here you see sectors like that mortgage REITs, consumer discretionary, and tech stocks. Now, mortgage REITs, companies like AG&C Investment, those tend to underperform because those short-term rates, which is their main funding source, those move higher quickly, and long-term interest rates may hit demand for mortgages. Tech stocks, they typically get hit during inflation for that reason that we talked about earlier, because high inflation tends to hit those high PE stocks hardest. If higher inflation makes those future cash flows less valuable, then it's in the tech stocks and the growth stocks that are going to get hit the hardest, where those future cash flows are going to be worth less. And finally here, consumer discretionary. Those companies in retail and others that make the things that we don't need, but we want to buy anyway. Those stocks get hurt because the consumers pull back on their spending. If the price of gasoline and milk jumps and your paycheck doesn't increase to cover it, you might have to buy one less Mocha Coca Latticino each week. So this is just telling me that you definitely want to be cautious about stocks of companies in the consumer discretionary sector heading into higher inflation. Now, if you've been following the channel, you know I've liked the sector on that value over the last year, but I really do think you need to be extremely careful here, especially into that next consumer price report. On the other hand, there are some sectors that just tend to do better during inflation. Energy is the obvious one here, the highest average return and the most likely to outperform inflation. This is because most of those high energy or high inflation periods have happened around oil price shocks. Now, equity REITs or real estate stocks, this is also another intuitive one because property tends to keep its value even as inflation eats away at the dollar. Two of these other sectors that do really well, stocks in the consumer staples and utilities, and I think this is more of a safety play by investors. The companies in both of these sectors sell those products that you have to buy, so they tend to have very stable and consistent cash flows and pay out those regular dividends. That means even if the companies aren't able to increase their prices quickly to keep up with inflation, the stocks still do relatively well versus the others because of the stability and cash flow and just that rush of investors into the shares for that safety. I hope that wasn't too detailed for you, but Nation, I want you to understand the why here. Why are certain stocks going to do better than others? So you can do your own analysis and pick your own stocks. I want you to be a better investor, not dependent on some Yahoo on YouTube to pick your stocks for you. All you out there in the nation know I love real estate, and we're adding Sabra Healthcare REIT, ticker SBRA, to the portfolio this month. Sabra leases properties to skilled nursing, senior housing, and specialty hospital companies, so a strong play on that long-term demographic trend on an aging population. Occupancy did take a hit during the pandemic, as it did with all senior living REITs. The company-wide occupancy fell as low as 75.7% in that skilled nursing unit, but Sabra has been able to collect 99.6% of its forecasted rent, so really taking advantage of its business model to avoid the worst of the hit. On a valuation basis, Sabra trades for just 8.4 times its expected funds from operations, even lower than another REIT I like, Omega Healthcare, ticker OHI. And remember, that's really the price multiple you want to look at with these real estate investment trusts, is that price to funds from operations, or FFO. The earnings reported on these stocks, it's not a good measure because of all the depreciation they take. So you really want to go with that cash flow approach. Now, just on the dividend yield, you can't help but look at this stock with its 8.9% dividend, well above other healthcare REITs. Analysts have an average target price of $15.77 a share, which would be 11.8% higher beyond that dividend yield for this stock. Check out the 2022 portfolio on StockCard or click on the video to the right for the 5 monthly dividend stocks that beat the QYLD. 5 stocks to put cash in your pocket every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.